Good morning, folks. We are just getting started here. Hope everyone's having a great trading week so far. So first, I want to thank you all for tuning in. This is going to be a fun episode of Back to the Futures. We're going to be covering a fair amount of content this morning, and then we're going to flip over to live order flow analysis after the opening bell. And as you have questions, feel free to post them in the chat rooms. We are live on Discord, Twitter, Twitch, Kick, Substack, and 2 YouTube. So a couple of different spots. So it might take me a moment to get back to you, but I'm definitely tuned into any and all questions that y'all might have to try to make sure we get the most out of these sessions that we do. So first and foremost, manage your risk, manage it close, manage it carefully, because you know what? You never want to learn about the fourth shape. And people are watching this with a blank stare. What is that fourth shape that you're talking about, Mayhem? I am so clueless right now. Here's the fourth shape. Portfolio God. It's the shape no one wants to learn about. And, you know, you can avoid it if you don't put too much at risk. If you manage your risk, the rewards will come to you in time. And there's a certain kind of discipline to all this as well. It's the discipline that defines traders versus gamblers. If you're gambling, every trade is a lottery ticket. You're going to put it all on black. You're hoping for the best, and eventually you're going to blow up your account. If you're trading, you're building a strategy. You're hoping that strategy will let you get better consistency. And if it doesn't, you're continuing to iterate and improve on that strategy until it does. And even then, you shouldn't be satisfied, but you should at least stop tinkering as much and start looking for areas of marginal improvement, or if the regime shifts, how you adapt to it. Now, one of the reasons I talk about risk management so much is because the math behind it is so important. If you lose 10% of your portfolio, you got to get 11% to get back. That's manageable, but then the numbers become progressively more difficult. I mean, look, if you lose 40% of your portfolio, you need a 67% gain to get back. 50%, needs 100%, 60%, 150%, 70%, 233%, 80%, 400% gain to get back to even. This is why it's so important to keep your losers small. One of the things that I practice myself and recommend to folks that I coach and work with, keep your losses at 1 to 2% of total portfolio liquidity. And that means you're sizing your positions and your stop outs based on the volatility of those positions. So that A, you're not just getting chewed out by stops, and B, if you do take a loss on a wider stop, it's not going to hurt you that bad. It's so important to embrace this very simple philosophy. Because if you can manage those losers, then you're going to have a much better chance at A, developing the discipline you need. Because I'll tell you what, a lot of people I talk to, they struggle with letting a loser go. The thesis sounded so good, but then reality hits and the position's not performing as thought. But maybe it'll just get back to break even. I would say forget it. Move on. Because if the trade didn't work out, it's wasting your time, your mental capital, and it's reinforcing bad habits if you're just moving your stops lower and lower and letting the losers run lower. You're supposed to really be doing it the other way. When you have a winner, move your stop to break even, then move it into profit, manage that gain, ride that gain, use that momentum to make money. But on the losing side, you got to cut out early, and that this chart explains why. And so a bit about me. I've been trading for 21 years, investing for 20 years. I've loved the journey. It's been ups and downs like any other journey in life, but the downs are formative and the ups give you an opportunity to celebrate what you learned during those downs. Because if you're doing it right, when you're not kicking butt in the market, you're figuring out why. You're spending time looking through your trading journal. And let me tell you right now, if you're not keeping a trading journal, you really should. It's so important to be accountable to yourself, to your own trades. You can look back at that trading journal, say once a week on Friday or Saturday or Sunday, look at the setups you took, how the trades went, and start to learn about what kind of trades work for you and what don't. And don't keep the journal just as sparse as I entered on this date with this size, and then I exited with this gain or loss. That's not super helpful. Talk about your state of mind. Talk about your thesis. Talk about how you got in. Did you get in all at once? Did you scale in? Talk about the sizing. Was it this much of your portfolio? Did it make you feel nervous having that much liquidity at risk? Remember, a journal is only as good as the information that you're putting in to review later. It doesn't need to be so verbose that each entry is a page long, but it should be detailed enough that you can get back into your state of mind as to where you were when you're putting on that trade and navigating it, and realize what kind of setups work and what don't, so that you can try to improve your process. Take a more systematic approach. If you want to improve your discipline and your consistency, but also take some of your emotion out, use back testing and signals that you can generate from those back tests to be able to become more disciplined in exit and entry on your trades. That way, it's not just crayon lines and emotion. It's actually using data to drive that. And you don't have to go back so far. You can use 3 to 5 years of backward-looking data to get a pretty good sense of the personality of a certain asset class under particular trading conditions, right? Like in a bull market with stocks, you can look at the S&P. You can get a sense that maybe an 8 EMA cross above a 21 EMA is a sign of positive momentum. You could use that as an entry, just like the cross under as an exit. If you start to adapt those strategies and build them, and you're able to beat your benchmark, then you've got something you can start to put into practice. And I'm going to tell you something else, and it's almost like a secret. If you look around and you look at all the excitement and all the flashy cars and the things that people talk about when trading should be boring. Yeah, you heard me right. It should be boring. If every day you're feeling an adrenaline rush, your heart rate's going up, you're feeling like, this is make or break, you're doing it wrong. That's more like gambling. It shouldn't be like that. That's dopamine driven trading. It's going to get you in trouble. It's all about serotonin driven trading. It's all about the long game, even in short time frames. And it's about rewiring our brain so we're not constantly looking for rewards where they may not exist. Because if we do that, we're more tempted to trade just for the sake of trading rather than having a setup. And that's why I like to use this comic to just be a little bit self-deprecating. But in reality, if you practice your strategy, you will become better at implementing it during the right times. So we can be really good at building our theory. We have our, our whole ideology about trading, but then when it comes down to brass tacks, we don't execute well. That's what this meme is kind of making fun of. It's a very human thing. The reality is that only comes from consistency. You build your strategy, you've got to execute on it, you've got to be confident about how it sets up your entry and your exit. And then as you do that over time, you will become more consistent. And you will start to see that the dopamine influenced trading is one of the things that's bringing you down. And if you focus not on the outcome, but on the process, you can become a better trader. All about your mindset. And I'll be posting a video on X later today. It's already on my YouTube about trading psychology. Highly recommend everyone watches it. It's a free video. It's 42 minutes long. And it's all about the things I've learned in my journey, 21 years of trading, about mastering your mindset so the emotions and the impulses don't get the better of your account. And I can't tell you how often that happens to people that even sometimes seem like they have some experience under their belt. Then they go on a tilt, emotions get the best of them, they're getting hurt. Then they try to revenge trade their way out of that pain. It compounds it. And you get folks that quit trading that have been doing this for a while because of circumstances like that come up. And you don't have to go through any of that if you take a lot of this emotion and impulse out. Now, granted, we're emotional creatures. We're prone to impulse. I'm not saying we can be 100% robotic. You can't be like my avatar on Twitter, right? Just a stoic robot trading without any emotion at all. But you can tone it down. And that happens by reinforcing those behavioral patterns. Those patterns then become habits, then they become baseline. So let's switch over, talk a little bit about what's going on in the precious metals markets. I think there's a lot of interesting things underneath the surface that are starting to play here. For one, gold bouncing off its 50-day moving average. That's quite encouraging. It's also a pretty big reversal off these lows, like a 10% reversal very quickly. So that is an encouraging move. I think the 50-day moving average for all of the metals is worth watching. And overall, I think we're in for some turbulence. I don't know that the worst is over yet. Obviously, as someone who's a long-term precious metals bull and has, various investments in the space, I'd love us to just kind of go right back to where we were. Hey, we shook the tree. We got the weak hands out. We're right back to the rally. But I would be cautious of taking that view without a little more confirmation. Today's price action is encouraging. There is no doubt about that. And I think the 50-day moving average gives us a line in the sand that we can draw on gold, silver, copper, palladium, and platinum to give us a kind of checkpoint to see whether or not that trend is still healthy, because we can see the same thing in silver. There we are, bouncing off the 50-day moving average and continuing that rally into today's tape. Pretty powerful move off the lows. And then here we are in copper, same look, bouncing off the 50-day moving average. Copper's like that level before, so is silver. And then here we are. I want to say this one is, so that last one was platinum. So we've got platinum also bouncing off the 50-day moving average right here. It's a level that it's flirted with before and has largely been support. And then finally, palladium. 50-day moving average, also important for this metal. So every single one of the big metals, gold, silver, copper, platinum, palladium, all showing interaction with the 50-day moving average and all pulling above it. I think that's kind of a big deal. Because what it's giving us a sense of is the market's very clearly drawing a line in the sand and saying, look, as long as we're above the 50-day moving average, you can lean into longs. If we start to break below the 50-day moving average, you're likely to see a number of other momentum-driven strategies start to dump here. I imagine there's CTA strategies that look at things like this. There's other kinds of algos. There's obviously us traders at home who like to look at these simple moving averages. And I'm going to say right now, I'm not a believer that simple moving averages simply just work because you're drawing a line that shows an average of price over some duration of time. I believe they work because other people believe they work. I believe they work because collective psychology is a very powerful force, and then it becomes embedded in decision-making models that are automated. So I believe it works because other people use it and they believe it works. That's kind of my theory on some of these lagging indicators like moving averages. It's simply something that we have to pay attention to, particularly when every metal is telling us to pay attention. So just take that as a note in the back of your head to watch over the weeks ahead how these metals behave with the 50-day moving average. Now, I again, very encouraged by the price action that we've seen so far. It's a very solid bounce off of these lows. So that's what we wanted to see. On the other side of it, however, the short dollar trade is still a pretty crowded trade. And I think that's something that's really warranting some discussion before we get super duper bullish on metals again. And I'm not saying that the dollar can't rise with metals alongside it. That's happened before. It's just a bit more challenging, especially when you start to see the long end coming up in terms of yields as well. You just have some more competition in terms of other duration assets that pay you to hold them. Now, granted, when you buy a 10-year note and you hold it for 10 years and you go to get, you get your principal back, it's worth a lot less. Gold doesn't really have that same problem. So the hope is that you get a yield that's good enough to compensate for that depreciation of the purchasing power. That's why you might buy something like that. And that's why it may provide some competition to things like gold. So that's just something to keep in the back of your mind as we talk about the next part of this. The dollar, the short dollar trade is so extraordinarily crowded here. That's something that I think we do need to keep in mind to just sort of guard our optimism about how far the precious metals rebound may go near term. Now, again, gold and silver can run with the dollar. It's more of a mixed track record. It's more of a coin toss. When the dollar's going down, they have a much easier time rising. When the dollar's rising, they can rise, but it's a lower probability scenario. And so when the weak dollar, kind of concept, the sell America trade, if you will, became really popular, it started to express itself in multiple different vehicles. So you can see the weaker dollar bets hitting a record premium, a sign of a crowded trade. You could see the options market massively hedging dollar downside with historic euro bullishness. I mean, there's not a lot of things to love about the euro right now, but that's just showing you how unpopular the dollar has become really recently. I mean, this has intensified quite a bit in January of this year. And we know that a weak dollar is unofficially part of trade policy. You want to bring trade back, you've got to weaken the dollar, you've got to make your exports cheaper. I get it. But when a trade becomes this crowded, you do want to be cautious. So I'd be super cautious of euro longs here. I'd be very, very cautious of wanting to be long the yen as well. I think everything that's going on in Japan says over the long term, the yen is only going to get weaker and weaker and weaker. So both of these pairs as a long, whether it's long yen or long euro, would not be attractive to me anyway. But then you add the positioning element to it. Maybe there's some fades here. Maybe there's some fades on the other side of this to take into consideration because the dollar is at multi-year trend line support as well, which we'll show in just a few charts. CTAs are also getting really, really crowded on the dollar short. These are momentum funds. They typically use strategies that involve things like moving averages. They'll fade weakness. They'll buy strength. They're very short the dollar as well. So you can see multiple different metrics showing that is a pretty crowded short trade. Then there's also futures positioning and options flows showing a record amount of net short positioning in this aggregate. This is a weekly change. So it's a biggest weekly change going short for this type of positioning in futures and options. So again, everyone's kind of jumping on a lopsided boat. It's already very, very crowded. It's not super surprising then when you bring up the dollar trend line that we're getting a bounce here. Not the most amazing bounce that's ever happened, but it is a bounce. This is a monthly chart. So I believe that this is one of the reasons that the metals had a difficult time. It's obviously not just this in a nutshell, but this is part of it. That you've got one of the thing. I mean, the metals are priced in dollars. So if the dollar is appreciating in any meaningful way, that can put some pressure on them. And we just got back to this major trend line. The short dollar trade's super duper crowded. So it made sense that we were going to pause. But you might be asking, Mayhem, is that all? Is it over? Precious metals market, the bull market, over? And is the dollar bear market, or at least the decline, over? And I'd say if history is any guide, probably not. So we have $4 bear markets on this chart. The average decline is about 34%. So if this is another dollar bear market, the sell America trade, and we're only down 12%, that suggests there could still be another 24% decline to come. Now, obviously, all markets are not built the same, but on the other side of it, you do have a government that's spending pretty aggressively. You have a new Fed chair, Warsh, who, if I had to guess, I think he's being overestimated in his hawkishness. And you have geopolitical uncertainty, you have economic uncertainty. The dollar is not as much a safe haven as it used to be. All these things could weigh on it. So we may get that multi-year trend line bounce. I'm not so sure it's going to hold up over the course of 2026. I think that as we start to get later into the first quarter and then start the second quarter, like that period from say mid-March to April, you're more likely to see the dollar start to really come back down again, possibly break that trend line. If it does, break that trend line, I think precious metals prices are going to go bonkers. That's kind of been my base case even from late last year, that watch that trend line, because a break there, and I think gold very quickly goes above 6,000. Silver very quickly goes above 150. Like that's a major line in the sand. And there are other reasons. There are macro factors that the dollar can continue to grind lower because its share in foreign exchange reserves has declined alongside its macro footprint. Basically, the de-dollarization process is still very much underway. This is not suddenly over and everything's fine for the dollar. I mean, you've got a lot of headwinds. You've also got this administration kind of rattling sabers, creating a lot of trade tensions, provoking more countries to move out of the dollar. And you had the Biden administration, which weaponized the dollar when Russia invaded Ukraine and caused more and more countries to want to de-dollarize, go into gold to diversify their foreign exchange holdings. So you have kind of this double header scaring people out of the dollar. And that bigger trend has not changed. So while we may get a bounce and some relief for the dollar near term, I don't think the long-term structural decline is by any means over. Now, you could see it here as well. The share of gold in global foreign exchange reserves. And when did this big takeoff happen? Gee, it happened after the weaponization of the dollar. And you can see the same chart expressed in many different ways, whether it's central bank gold buying or gold as a part of foreign reserves or otherwise. Gold is taking a bigger role in the global financial system again. And part of that has to do with de-dollarization, which in many ways was self-inflicted. There are policies that are causing more countries not to want to use the dollar, and that's leading to both the simultaneous drop in treasuries and rise in the dollar. Now, some of this drop in treasuries is because they're dropping in value, but some of it is also because countries are selling or not buying more to replace what's maturing. Let's shift gears a little bit to silver again. I just want to talk about how crazy the inflows had become in the SLV ETF. I mean, this is absolutely bonkers. And you had tons and tons of institutional mentions and retail mentions of SLV as this huge, huge amount of inflow is happening. So it got to be a very crowded trade, whether it was the vol skew being lopsided, record volume coming into SLV, there were a lot of signs that the room from SLV versus this 200-day moving average, there was a lot of signs that things were getting a bit extended. So all we needed with everyone on one side of the boat was a catalyst to tip it. And apparently this was it. Now, this is what people are saying. I will say personally, I don't think Warsh is going to be as big of a hawk as he's being made out to be. That's my 2 cents. I think he's going to, like every other Fed chair, be under the thumb of the financial elite who want asset inflation. So they're always going to lean into wanting stimulus over wanting tightening. And I believe that he will succumb to that sort of pressure because every single Fed chair has for decades and decades and decades. I don't think this is going to be the guy who changes everything. So I believe that the unwind that happened, if we're to believe this is the catalyst, obviously it was a crowded trade, so it doesn't take much. But I don't think this is enough to end the precious metals bull market, despite Friday looking like this. If you were long any of these things, I mean, literally, the candle was so bad, it went through the table into the floor. You got to love this meme. You can recycle it ad nauseum for any of these, but that's what it felt like. But that was also a capitulation flush because look at the volume in silver there. That was the biggest volume ever. Now, on the way up, the prior biggest day was something like 36 billion, which was bigger than Tesla and Nvidia combined in terms of the flow that those stocks see on a daily basis. SLV was bigger than even SPY. So we got to some extremes, like one silver ETF being that big of a part of the market was getting a little crazy. But then on the other side of it, that sell side pressure looks like capitulation. That was the most turnover in the ETF ever. And I will say February silver seasonality is not amazing. We may chop a bit this month. Only 20% of the time over the last 5 years in February was SLV up. On average, it was down 1.2% during that time frame. So seasonality doesn't favor silver. We may consolidate if we do. And I'll be honest, I kind of hope we do consolidate to build some healthier market structure. You probably heard me talking about that on these streams quite a bit. I'm still of that mind. And gold positioning, believe it or not, has come down. The net longs from non-commercials have come down quite a bit from their highs. That's a good sign. That's a sign that there's already some profit taking, that the gold side of the trade isn't quite as crowded when you look at futures. So to me, that's encouraging. And I think that in terms of the downside in precious metals, the worst may be behind us, but we do need to be patient about looking for that next leg up. Without a catalyst, you could still see some chop and some consolidation in this range we're kind of building now. Let's shift over to the US stock market. S&P 500, we're just about 2 minutes from the open, but I've got some more slides I want to share before we switch over. First, the S&P 500 is now trapped in a new infernal range, tapping the upside. This is just around the wall of calls. That's around 70.26 on the March futures contract. That corresponds to 7,000 on SPX. That's the delta. It shrinks as we get closer to the futures expiration date. Now, why is this important? Because there's energy being pent up in this consolidation. Whichever way it resolves, you're likely to get a pretty meaningful move. I'm inclined to think it wants to resolve higher based on the way this chart keeps tapping the top of this. The more you kind of knock on those levels of resistance or support, the more likely they're able to break. So I do believe we're more likely to break, but this is also a crowded market right now. So we could get even like a sort of head fake type of break and come back to the bottom of the range just because of how crowded the positioning and flows are and how bullish the sentiment is. I'm not saying that's the case. I would be inclined to think we could actually break above, tag that call wall, start to build there, and then maybe consolidate for a bit more above this range. But what I am saying is because of how crowded the market is right now, one should be pretty careful because liquidity is dried up in the futures. Long positioning on the longer term positions that have opened is really crowded. So that means if you get a catalyst, this thing can move really quickly in either direction. The Nasdaq has a kind of similar look to it. There's a bit of a ceiling overhead just around price. I'm inclined because of the number of times we've, kind of broken above and knocked on the ceiling. We're likely to follow through higher. But what concerns me is this. This is a really crowded market. The Bank of America Bull and Bear indicator rose to 9.4. That is what they call a sell because of how crowded this market is. And you can see it in other places as well. No one wants to short SPY or triple Q here. And for triple Q, I think this is an all-time low of short interest. For SPY, not quite as much. It's a more popular hedging vehicle, but it just shows no one wants to be shorting tech, even when there are some signs of concern. This is Microsoft's CapEx, largely driven by AI, and it continues to surge with a compound annual growth rate of about 33%. What's problematic about this for me is that, you can see it in the market. The market's concerned about this. Microsoft was marked down something like negative 11% after its earnings release. The CapEx is not providing a return on investment, and investors are starting to become less patient. With AI being a big part of the driver of this upside, we have to monitor this narrative. If there is to be a risk off catalyst, it's probably going to come from the Gen AI CapEx growth narrative. And if it does, perhaps the VIX is going to follow the VVIX, or the volatility of volatility higher, into March. Seasonality in March is really good for volatility, not so good for equities. So it would be a natural place to see some de-risking. We've seen it. You can set it like almost a clock every year. There's some kind of de-risking in March as well as September, October. So as we approach March, I think it's going to be a good time to look at some hedging strategies to be able to navigate that potential increase in volatility. There are also some crowded trades specifically. Underneath the surface, you've seen this huge bid into cyclicals. And I think that there are good opportunities even in this space. There's good opportunities in some of the regionals that have been marked down and some of the energy stocks that are absolutely beaten down and hated. But you can see in technology, the interest has waned, which brings me to this next chart. Semis, super crowded. Software, everyone hates it. I'm starting to become much more interested in software. I've shared some names on the Trader A Discord that I'd be interested in buying as we see this shakeout. I don't think it's quite over yet in software, but I do think that it's starting to get to a point where you want to make a name to buy these companies, make a list, I should say, to buy these companies with both hands, because there are still many names in the software space that even with AI and their, the capabilities to more easily create applications, they're going to have a durable competitive moat. One of those names I will say is Palantir, but I don't like the valuation, so I wouldn't recommend buying it here. Now, let's switch over to Bitcoin, and then we're going to get right into it and do some live order flow analysis using Bookmap. Bitcoin, we talked about this low volume node below. We have broke below that range. We've talked about this range for such a long time on these conversations. I mean, I think this was months that we were stuck in this range. We had this fake breakout, and now we've broken well below the bottom of the range, and we're in this low volume node. And it suggests with the heaviness of this chart that we could get back to about 69,000 in Bitcoin. This is also a head and shoulders chart. So if that level can't hold from the prior levels of resistance it provided, which can become support as well, it could very easily start to come back down to about 45,900. So be cautious in crypto. I think there are still more headwinds in this space. It's not likely to catch much of a bid in my mind until we see liquidity really come back. And that's looking at reverse repos, it's looking at bank reserves, it's looking at other measures of global liquidity. They're just more constrained here. And that's one reason, with Bitcoin and other crypto being a relief valve for excess liquidity, there's not that excess liquidity. So there's not that speculative bid buying all the dips and pushing these things higher. It's also a somewhat crowded trade. This is the number of net long futures contracts as of Jan 27. Obviously, that's probably come down a bit with the shakeout, but it's still extended to the long side. And as with every cycle, there are periods where it feels like it's completely over. I'm sure a lot of people felt like that on Friday with metals. Now it feels like we're back. It's only, been several days. This is the cycle. This is how markets work. Don't let your emotions get the best of you. And really quickly, these are our weekly pivots for this week. I'm going to share these out on social media as well. You're welcome to take a screenshot for your own purposes, but these are the levels where I would be bullish above and bearish below for S&P, Nasdaq, gold, and silver. And I'm just popping that out on X. All done. And so we're going to just really quickly talk about two more slides and then dive into Bookmap here. First is some really awesome deals we have. You can get up 20% off Trader Aid using the code Mayhem20 at checkout. We've got some awesome trading tools, research, actionable ideas, and an amazing community of traders. And get up to 40% off Bookmap. Visit traderaid.com/bookmap. Scroll down to the special offers. And the Bookmap team would also like you to know about the Trade Control Challenge. Show us your best trade. Use the hashtag FreeBlueJacket. Winners will get this awesome hoodie. So we're going to now break away from the slides. Thanks for staying tuned for that. I thought that was a lot of fun. Always interested in your questions and feedback. So I'll be checking the chats. But we have a market that is open here. We can see a bit of a trading range starting to form. This is actually a pretty decent trading range so far. Let me see if we can mark the highs and lows with that price range. Yeah, here we go. Price levels. Just pop that in there and have it do a little bit of analytics on the data. There we go. We've got top of range around 17, bottom range around 350. So this is already setting up to be a pretty decent opening range. So you see a bit of iceberg selling here. You can also see that on the subchart. Icebergs are passive orders. What that means is you've got a trading desk that doesn't want to show their total size, so they'll basically put in a limit order, and the limit order will continue to reset until the full size of what they want to sell has been sold. So say if they wanted to sell 1,000 S&P contracts, they may only show 200 at a time so as not to freak out the order book. And then once those five orders are processed for a total of 1,000, that iceberg is finished. So icebergs, typically the reason for them is you want best pricing. You're not as concerned about timing as getting the price that you desire to execute at. So you're patient and you're also not showing full size. And the reason for that is you don't want to spook price away from your order. The disadvantage is that it's going to take longer to execute an iceberg. And once the first chunk of that order is executed, like in this case, the first 200 contracts in our theoretical order, you're pushed back to the back of the queue. So that means other orders may execute ahead of you. So again, icebergs are about trying to get the best pricing and execution, but they're passive orders. They're not meant to influence price. But when they become large enough in aggregate, they certainly can. And we are breaking below the bottom of today's trading range and the point of control here as sellers start to take control. Now let's zoom out just a little bit for the overnight session. And we could see Globex actually was just really a ping pong match. The point of control acted as support during Globex. We're testing it now during regular trading hours. And we're exploring a fair amount of that range here in this open. But what I'd be looking for, I think, is probably some range expansion to the downside based on the way this is trading. Let's see how it plays out. But so far, this feels like sellers are pretty motivated at this open. We're also going to take a look at the Nasdaq here. Similar look, just some pretty motivated de-risking flows in the Nasdaq. Gonna just take a quick look at the heat map on my end here. Could see really, wow. We were talking about software. Software is getting absolutely shellacked, that whole space. So yeah, we'll bring this up. Remember, I said soon. We're not quite there yet, apparently. There's the software space once again today getting just really beaten down. And I will say, when this sell shakes out in software, there are going to be some great opportunities among these companies. We're just not quite there yet. And that's one of the reasons of the Nasdaq's dropping. You've also got some sells and financials and asset managers. You got the big tech names like Microsoft, Nvidia. They're selling off. Oracle selling off a bit. So not the best day in tech. The rest of the S&P doesn't look quite as bad. There is a bit of a rotation into more defensive spaces like consumer staples, utilities, healthcare. You also see some interest in the cyclicals, some of the money center banks, industrials, energy, basic materials getting a bid here. So a continued rotation. And that does make the Nasdaq look heavier than the S&P. If one was to fade one of the two, I'd be looking at the Nasdaq right now with the heaviness we're seeing in a lot of the bigger names. Let's take a look at gold here. I'm going to have to move that contract over one, so give me a second. We'll first take a look at silver. Silver is absolutely rocketing. I will say it is crazy how quickly things are changing in the metals markets. Having traded these things for about 20 years, I can tell you typically these rotations from bearish setups to bullish setups have periods of consolidation between them. It's almost as if like we've just sort of accelerated a lot of these resolution times, whether it's in stocks or apparently in metals, because everything in the metals complex is bid heavily today. Silver's up over 13%, gold's up over 6%. So is platinum, so is palladium, copper's up 4%. Just everything is surging as if last week, excuse me, as if last week didn't even happen. And gold has been rotated to the J contract. So let me take a moment to update that. And the we'll keep silver on screen for a minute here. This price action in silver is actually very interesting. And I'm going to do one other thing. I'm going to bring up SLV so we can just look at some of the options flows that are going on in precious metals as well. So let me pop that up and give it a moment to pull its data. But I've been working on adding features to the options viz for just about anything that we want to map out. And so we've got that for SLV here as well. And guess what? There is some confluence here between where we're seeing resistance and the wall of calls in SLV. Wouldn't you know it? That was also a large area of offered liquidity. These big even numbers tend to be pretty magnetic for options and for areas of liquidity on bid and on offer. But when you see the confluence between the two, it is more meaningful. So I'd be watching 80 and SLV here as a formidable area of resistance. And we can see a bit of seller aggression picking up there as well. Speaking of seller aggression, we talked about the S&P looking heavy and leaning a little bit more bearish on that in the Nasdaq. We can see that continuation to the downside here. The opening range is certainly expanding and looking a lot more interesting, but on the other side of it, you can see sellers really got aggressive here. There was a pretty large iceberg. We saw some seller exhaustion and a big stop out in this move lower. So that gave buyers the opportunity to try to make a push back here. We'll see if they're able to do much. There's certainly more aggression showing, But when we were talking about the market looking a bit heavy, we definitely got some extension lower from that look. Sellers really leaned in. And as is almost like you could set your watch to it, sellers got too aggressive and they kind of got a little bit too heavy into this sell right here. The seller exhaustion signal I built identified that too. There was a pretty big exhaustion print in that move lower. So that creates like an opportunity to scalp long, maybe get back up to that point of control. But I wouldn't be too convinced of more upside unless we can break above that point of control and build acceptance. We can also see we are, besides the point of control, there's VWAP in this volatility trigger level. So that gives us a sense that as we chop lower here and build acceptance below that point of control, if we stay down here, there's room for sellers to make another bigger push lower. And news coming across the wire is that the House Speaker Johnson believes they have the votes to reopen the government. I know that there's folks out there saying government shutdowns are, something to be scared about. Typically, they don't have much of an impact on the market, and the more of these shutdowns we get, the less of an impact they have. But I would also add one other note that it's a misnomer. It's not really a shutdown because most of the government's still open. Let's take a look at silver here. Silver's still struggling to break above that 80 level. That's also where the point of control has been pulled up by buyers. Now, there is a pretty significant amount of motivated buying going on here. So this may just be a temporary blip and we continue higher. But for now, we're just consolidating around that 80 strike. Let's also take a look at crypto, Bitcoin. Bitcoin had a really nasty weekend. We are exploring a low volume node right now in Bitcoin. So I would expect it to be very, very volatile, which if you're trading it means smaller size and wider stops. That's pretty much the recipe when something becomes more volatile for whatever reason. In this case, it's in an LVN or low volume node. Widen those stops and reduce size if you want to trade this. Because when you're in a low volume node, basically that's a part of the volume profile where folks didn't want to transact as much. So you're likely to see much higher levels of volatility in both directions. Going back to the S&P, we can see off that seller exhaustion print that we are seeing a decent bid. We're actually now pushing above the point of control and building some acceptance here. So it's starting to look a little bit better. And once again, looks like sellers really dropped the ball pushing this hard this quickly. You can almost set your watch to it, the number of times that sellers just drop the ball on the S&P or the Nasdaq. Order book pretty even across the stacked offers and bids so far. And that's a nice chunky opening range. I mean, this sets up for a pretty dynamic trading day. You're talking about over 20 handles. And Tuesdays have about a 60% chance of being double break days as well. So even if we break one side of the range and build acceptance, it doesn't mean we can't reverse. For whatever reason, Tuesdays just have a higher potential of that kind of double-sided break. Big markdown, just as an aside, in Gartner shares. Gartner down 25%. They beat Q4 estimates, but their guidance looks really bad. This is a company that's just been absolutely eaten alive by the AI trend. And a lot of the things that they once did that made them unique are now being commoditized. So this company was trading, oh, what, $576 a share, now trading 153.21 in less than a year. Maybe, maybe just over a year, but probably less than a year. Pretty sad to see. But that gives you a sense that for any investment you have, if the thesis changes, don't fall in love with the company, fall in love with your ability to preserve your capital because these things change all the time. And unlike the software space, where I do think there's opportunities, I don't have any reason to want to buy the dip in Gartner. Yeah, big deal. There are. That's something that we can talk about during a future session. I just I'm just building a partnership with Edgeful, and their whole platform is about exactly these statistics. So expect some more content, collaborative content that talks about these types of trading statistics and the outcomes, and even some things that we'll be bringing on board TraderAid as a result. You got it, bud. It's going to be a really awesome year for us. A lot of cool stuff in the pipeline. I'm really excited. And so, S&P continuing to flirt with this point of control. We had started to build some acceptance up here. We saw an attempt by buyers to kind of break above, and then immediately sellers started to come back in. And now we're retesting that point of control in the S&P. Across the broader market, the breadth is pretty good overall. We've got 62% advancers versus 33% of decliners across all US listed shares. So that's actually good to see. Most of the de-risking is happening in tech. A bunch of the rest of the market is bid, and we're starting to see Amazon, Tesla, Google, and Meta come off their lows. Walmart also trading at $1 trillion valuation for the first time in its history. And Witty asks, which platform do you stream to? I stream to X, I stream to YouTube, Twitch, Kick, and Substack. And I'm also streaming to the Bookmap YouTube and their Discord right now. So a bunch of different places. Overall, sellers, once again, can't really do much. Let's see if buyers can take out this offer overhead. Then we don't have too much stacked liquidity until 70.20, which has been a pretty chunky area of resistance in this trading range. Thank you. Yeah, for the deals, check out the Bookmap deal. You can check out traderaid.com/bookmap. Scroll down to the special offers, and then we also have a 20% off deal for your first billing period of TraderAid. You can use the code Mayhem20 at checkout. Let's take a look at the flow here, see what options traders are telling us. So there is some heavy put flow again this morning. Looks a lot like what we saw yesterday, and we were able to move higher. Now I'm going to say you've got to use some nuance in these situations. Is the put flow a straight directional bet? Is it a hedge? Is it value at risk management? Because if it's the latter, you could have folks that are hedging out their longs so they can add to buying power. So seeing put flow go heavy doesn't automatically mean the market has to go lower. Although if there's an absence of buyers, that's exactly what it's going to do. But on the other hand, you can have folks that are hedging out their longs so they can buy more longs. That's a concept of value at risk. Basically, if you have too much value at risk, you can't extend your long exposure. But instead of selling longs, one way you can reduce your value at risk is to hedge them out, and then you can continue buying. That is something that we saw yesterday, and it could be what we're seeing this morning as well. We'll certainly be keeping an eye on that. Another bit of news is we will not get jobs data. NFP data on Friday has been canceled as a result of the government shutdown. And sellers taking this to new lows here. We formed the 20-minute opening range, and now we're breaking below it. So if we're going to be looking at opening range theory, in a nutshell, the longer we spend down here, the more likely it is that it could become a downwardly trending day. And we also have that heavier put flow below, which we can't ignore. Whatever the motivation for it, if buyers aren't able to step up and we don't see the buying flows coming in to the other parts of the market to offset it, it suggests we can get pulled lower. So we've got some areas of support to watch here. Gamma flip tends to be an area of reaction. Gamma 1 tends to be an area where there's some magnetism. Do have some bids starting to build below, so interest in lower prices is increasing. And that flow to the puts is certainly much larger than that to the calls. So we got to keep an eye on that, particularly as we're breaking below the bottom of the range here. And then in the heat map, we can see that there's a reversal in some of those names that were coming off the lows. Amazon, Tesla now red again, Meta flat. Software selling in these technology names is increasing. We're also seeing some of the other high flyers coming down. Shares of Micron down 3.5%, Qualcomm down 2.85%, NXP semis down 9.45%. So definitely some de-risking across tech. I bet Nasdaq looks real ugly. Yeah. Yeah, it's just continuing to roll over to new lows, and this is another one where we formed a pretty chunky opening range. We're talking about like 250 points. Now we're breaking below it, which suggests we've got continuation room lower. We did talk a little bit in the pre-market stream about how lopsided the longs were, and there is formidable resistance overhead in both the S&P and the Nasdaq. So we could just chop right back to the bottom of this range on the S&P and the Nasdaq as well. Take a look at silver here. Silver was able to make a nice little tidy break. We got above that level of resistance we had seen earlier, but now we saw a rejection at 89 where there's about 129 contracts of offered liquidity. If we look at that via SLV, we can see the most active calls at that call wall at 80, where there's confluence with the point of control. We were able to make a break above there, but just like in the silver futures contract in SLV, there's also this large area of offered liquidity above, and that's providing resistance. So I'd be watching VWAP here for support. That's around 79.30. And selling in the futures is continuing to intensify. S&P now testing the gamma flip level. If we break below it, we start to get into neutral gamma, and then the further down we get, we start to pull into negative gamma, which changes how dealers hedge their options exposure. Basically, in negative gamma, you get into a chase dynamic where rips are bought, dips are sold, so it exaggerates volatility. So I got a quick question about Netflix. Netflix has a put wall at let's see here. Just want to make sure I got these numbers right. Yeah, Netflix has a put wall at 80. So I'd be watching that level for reaction on Netflix. You want to watch whether they continue to roll lower. Since you're on the Discord, big deal. You can check the bot queries channel using the Gamma tool to map out those Gamma profiles, as they're evolving. So what you wouldn't want to see is more interest in puts building below 80. And selling pressure in these markets is continuing. We are getting down to a level of potential support here at Gamma 1. But once we broke below that opening range and built acceptance, it was kind of game over. And sellers are actually, to their credit, they're doing a pretty good job pulling this lower. You got it. Folks, if you want to learn more about my work, check out traderaid.com. We've got an awesome community of traders from all walks of life, some cutting edge trading tools, actionable ideas. Would love to see your faces around there hanging out. You can get 20% off using the code Mayhem20 at checkout. You can also get up to 40% off of Bookmap using the link traderaid.com/bookmap to scroll down to the special offers. Appreciate you all tuning in. I'll be back next week, 9 a.m. Eastern, for the next episode of Back to the Futures with me, Markets and Mayhem. Hope to see you then.